Someone I genuinely deeply respect and absolutely love talking to. Nomi Prins is here. Nomi Prins is a former partner with Goldman Sachs who actually quit her career on Wall Street to become a journalist and a bit of a whistleblower. She's the author of several incredible books, including All the President's Bankers and Collusion, how the central banks rigged the world. She also has an upcoming book that I'm looking forward to reading, Permanent Distortion: How Financial Markets Abandoned the Real Economy Forever. Nomi, thank you so much for joining us.
Thank you so much, Anna. It's great to see you again.
It's so good to see you. I know you've been busy working on your latest book. Very excited. It's coming out October 11th of 2022. So I'm very excited to read that. And you recently testified before the Senate Budget Committee. And I want to hear more about that because you were specifically talking about something that's been catching everyone's attention, which is private equity firms, the amount of power they have, and more importantly, the impact they've had on the housing market. So talk to me a little bit about what you've been noticing with these private equity firms and the type of impact they've had on both the economy and the day-to-day lives of ordinary Americans.
Yeah, so the testimony I gave connected what private equity is doing with companies like BlackRock, which basically own so many assets, so much of people's money, and also work with private equity firms to basically buy up all sorts of things, components of companies, of course, through stock, as well as components of the housing market. As we've seen, housing prices have gone crazy high in the last couple years, and often a lot of these houses are not bought by actual real people applying for actual real mortgages. They're bought up by sort of consortiums of private equity companies that are components and funded by some of the assets of management companies like BlackRock to effectively bid up and buy up with leveraged money, because money is so cheap and so easily available to these companies, housing projects, homes, without even going into them, without even potentially living in them. And that's increased the price for real people and actually kept them out of markets and basically being able to buy homes for themselves and their families. It's also made rents go sky high because they're basically cornering a portion of the housing market without actually using it, in which case they can go about and raise rents sky high, which then increase the rents around those particular buys. So it's an incredibly knock-on and circular effect. It's fed by cheap money, it's leveraged, and it's a really partnership between the private equity firms doing it and the large asset management companies that can work with them.
So we've talked about this on the show before, but I want to back up a little bit for anyone who might not be familiar with this story. I think it's really important to understand how the system works. So when you mention cheap money, talk to me a little bit about what that means. Where do they get the cheap money from? And also, what does it mean to be leveraged? What does leveraged money mean?
So leverage is like borrowing way more times than you need in order to make basically bets. It's the equivalent of like, you go into say a casino and you've got $10 in your pocket and you ask 10 other people for $100 in total, but you promise each of them you can pay them back with 10 in case you lose all that money, but you only have 10. So that's a leverage of basically 10 to 1. The reason I talk about cheap money and how these firms, and in particular the big banks and big asset managers, can basically borrow money and leverage it in this way multiple times against whatever they are buying is because rates have been so very low. Now, of course, in the news, there's all this talk about how the Fed is going to raise rates to fight inflation, even though it didn't even notice inflation was a thing until everybody else did. And they did raise rates by 25 basis points, 0.25% in March. But the point being that we are still in an environment where the cost of money, particularly to the financial industry, to Wall Street, is very, very cheap. They don't pay what real people pay for mortgages. They don't pay what real people pay for interest rates on credit cards. They have access to money very, very cheaply, and they sort of dole it out to each other. And in that way, they can create a lot of money out of nothing based on it being cheaply available, and real ordinary people cannot. And what that does is it inflates the price of everything more than it would otherwise be inflated, which again hurts ordinary people on a one-to-one basis because real people don't leverage their lives in that way.
Exactly, and I mean, when inflation started, and you're absolutely right, the Federal Reserve kept repeating that it was just transitory, it's temporary, don't worry, it's because of supply chain disruptions, didn't want to take responsibility for its role in inflation. But talk a little bit about how, you've been writing and speaking quite a bit about quantitative easing. And so that has played a role in the inflation that we're experiencing, certainly in the housing market. And now all of a sudden we're hearing about rising interest rates. Can you talk a little bit about why the Federal Reserve felt the need to provide, as they say, liquidity to big banks and to financial markets? What was the reasoning or excuse that they gave to the American people?
Yeah, no, that's an excellent question. Quantitative easing, just to break the words down, is just a wonky way of saying making money cheap for the big players in the markets. But basically it was done in two main chunks. One was after the financial crisis of 2008, where the Fed came in and basically cut interest rates to zero. Again, mostly that 0% availability was to the big banks and Wall Street. What they also did was bought about $4.5 trillion worth of bonds, of treasury bonds, of mortgage bonds from the market, through the fabrication of effectively cheap or just created money. It wasn't money that was produced. It wasn't money that was connected to the real economy. So that was one way of inflating the type of money that was available at a cheap level to the system, right? And then the second time they went and did this, the excuse was, well, we just had a pandemic. It was in the beginning of 2020. Let's just like blow up our balance sheet, i.e. create another $4.5 trillion, so double in a much shorter period of time what it had created in the wake of the financial crisis in order to, quote, ostensibly help the economy. Now, the reality is that the money was not all available to the real economy. It did not go into building the real economy. A teeny bit of it around the edges, did go into some of the programs that did help people and small businesses survive during the worst parts of the pandemic and closures. But it was very, very tiny compared to this leverage and this backing to debt and to the types of money that went to Wall Street and ultimately went into the stock markets. And so this was all under the guise of quantitative easing, or basically not just reducing interest rates, but creating money in order to buy debt and take it out of the market and let market players use that money to basically leverage themselves and speculate.
The thing that kind of confuses me about this is, as you mentioned, after 2008, after that economic collapse, you really see the Federal Reserve engage in this behavior with quantitative easing. And up until now, there hadn't really been much inflation. What triggered the inflation that we're experiencing at this moment? Like, why did it all just kind of hit us at once?
Yeah, it's a really good question, and it's important just to step back and look at this whole distortion, or what I call permanent distortion now, between the markets and that availability of this excess abundance of cheap money relative to the real economy. What happened was two things. When the Fed created money effectively cheaply, and that money went into a lot of the financial markets, it inflated something called the money supply. Basically, money supply is what people buy and sell, the money they use, bank accounts, et cetera. But it's also the reserves that are at the Federal Reserve that banks effectively give the Fed their debt, their assets, and the Fed gives them money, no strings attached, and they can use that money to do other things with. That creates an inflation of money, this bubble of money. Now, separately to that, we had real problems right now what we're seeing in oil and commodities, in food, in supply chains, and that was another side of inflation that was happening in the real economy. So what you had was two things going on, and this is why the numbers have gotten so bad and why CPI was at 8.5% in the last reading. Because the real economy is dealing with two things. It's dealing with supply chain, like real economic problems, real transportation problems, real excess costs of everything from putting gas in your car to getting products from one country to another to your supermarket. So there's a lot of things going on in terms of supply chains, and that's a whole other detailed topic, but that's the generality of it. But in addition, what's happening is this excess money is finding these types of assets. It's finding oil, it's finding some of the food, and it's basically going in and betting on it in a way that exacerbates the inflation that's real. That is created because of supply chains and because of the demand for certain products that came out of the awakening of the economy after the pandemic. So there's two levels of this inflation, and both of them have been inflated, to use inflation twice, by this excess money. One by speculation, and one by the fact that it's been so cheap, and that's been exacerbated by the supply chains. And now it's a bigger thing. And the Fed, as you mentioned before, has just literally not recognized its role in inflating this abundance of money that's available to the biggest market players, while real inflation, the real economy, is trying to scrounge to find products and get products from A to B and pay for it. And so both of those two things are going on at the same time, which is why we're hearing and talking about it so much more now.
So the Federal Reserve is now slowly increasing interest rates, but I heard a prediction of yours recently during an interview that you had, and I think that your prediction is accurate. You claim that, listen, I mean, they're gonna maybe raise interest rates 2, maybe 3 times, but as soon as they notice the impact that it's having on the stock market, for instance, they're probably gonna go back to the same old, same old. Why do you think that's the case? And what kind of impact do you think that's gonna have in the long term?
So I think it's the case that the Fed talks kind of about a hawkish kind of stance, and there's been a lot of predictions in the general market that take that at face value, which is that we're going to have 6 or 7 increases, that the Fed's going to really reduce its book, this almost $9 trillion of money it's created quite quickly, and that this is going to be some way of stabilizing what is a combination of all this money that's really gone into inflating the markets, as well as the real inflation that's happening in the overall economy. The reality is the Fed watches markets. It has a dual mandate, and I say this a lot, and it just continues to just be obvious from the events that ultimately take place, which is that it's supposed to mandate price stability, and that's why it talks about inflation. It has a 2% band that it tries to target, obviously, or way above that. So not did that really well. And then also, it's supposed to have a full employment target. Right, and we're a bit closer to that with some of the jobs coming back, but of course, a lot of people not choosing to work in this particular economy because of a host of other reasons. So anyway, that's the actual official mandate, that dual mandate. The third thing that I think they focus on are the markets. Now, if you look at just one little example, which is Federal Reserve Chairman Jerome Powell, he has a lot of his own money. It depends, the estimates put it anywhere between $25 and $60 million, depending on what's going on with the markets, where it is, et cetera, with companies like BlackRock, who also was given basically a no bid opportunity to manage the Fed's book, which is effectively, this quantitative easing money that was fabricated out of nowhere. So because there's a lot of synergy between the people that run the Fed, Congress that owns a lot of the stock market, the companies that they choose to basically manage some of this money on behalf of themselves, and the market itself, and Wall Street, throw all that together, and the Fed doesn't really have a strong impetus to just mess all that up by making the cost of money really, really high. And this has been what we've seen since the financial crisis of 2008. They will raise rates a little bit. They'll usually say they're going to raise rates or forecast they're going to raise rates by more than they actually do. So they've got some room to kind of step back and look at, quote, the data. What's the data? Well, the economy is going to slow down because inflation's so high and people don't have all this excess money that some of the Wall Street players have in like their real life, because we have a war going on in the Ukraine, because we have incredible inflation around the world, because we have more disruptions in supply chains now in China with another bout of closures, because of all these reasons that effectively are going to create a situation where it's going to be obvious that the economy is not growing as fast as some of those inflation numbers say. And the Fed's going to be able to say, look, we've got all these other reasons not to do as much as we were going to do. We're just going to keep things as close to what they are as possible. We'll raise rates a bit. I mean, it's not like they're going to stop. They're still going to raise rates, I think, in May and maybe another time throughout the year. But they're going to pedal back a lot from this the sort of forecast that they promoted.
Yeah, I mean, you touched on, I think, the most important element to this entire system, which is the conflict of interest, where you have the head of the Federal Reserve personally invested in the markets to the tune of tens of millions of dollars. And so if increasing interest rates is gonna have an impact on his stock portfolio, is that going to inform his decision making? I would venture to say yes.